Welcome to the MarketEdge Tech Talk with Will Paule and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, May 24th, 2022. I'm your host, Will Paule, and I'm here with my co-host, David Blake. How are you doing today, David?
I'm doing good, Will. Thanks.
All right, let's start off with a look at what the market's been doing this past week with a look at the market letter.
All right, well, last week, the big news was we had the S&P 500 finally dipped midday into a bear market on, I believe it was Thursday, when we had a big sell-off. It did finish, was able to come out of there, but we're not done with the bear market yet. Anyway, but last week we had the Dow Jones down for 9th consecutive week, and that's the longest weekly losing streak since 1923. I thought that was amazing, which just kind of shows you that we're in a situation where people just do not want to look at equities right now with the rising rates and inflation going crazy and oil going crazy, and also that was a bad sign. We also had the S&P 500 and NASDAQ. They've been down for 8 weeks, and that's the longest losing streak for them since 2001. So it's a bear market, and it still doesn't look good. And we had the bulls. I said in the letter, kind of nosed the gate early in the week. That means they on some better expected economic date, they try to give a little shove and move up, start the week. Had a little bit of a rally on Monday, but then and Tuesday I think we were kind of mixed. But then Powell came out and basically said, I think on Wednesday, that the Federal Reserve needs to do all they can to get fight this inflation. They've got to act more aggressively. That's what they're going to do. We saw rates move a little higher, and equities moved a little bit lower, but not much. I mean, Wednesday after his speech, it was kind of surprising that he could say that and not have the market really react to it. I mentioned in the daily commentary that I was surprised that investors kind of shrugged that off. But then we came in on Thursday, and boy, it hit home. We had the Dow Jones dropped 1,164 points. That's 3.57%. That's the biggest one-day point loss since June of 2020. And we had the NASDAQ tumble 4.75%. That was mainly on big cap tech shares. You've seen the Nvidias and all that just get pummeled here. They're down 30-40%. And then we had more selling in from disappointing earnings, especially with the consumer discretionary stocks and staple stocks. We had Walmart came out. It was down, I think, 10-11%. Target came out. It was down like 20%. That pulled the S&P Retail ETF, and the symbol on that is XRT. That was down 8.29%. That's a fund going down almost 8.29% in a single day. You don't see that very often. So they were just dumping retail stocks left and right. That's continued. You had Abercrombie and Fitch. They disappointed. It was down, I think, 29% earlier today. You had Ross Stores. I think yesterday they were the retail wreck of the day. And now today you're getting more selling in some of the big cap tech stocks that just haven't been able to hold up. As far as crude oil prices, it moved higher again last week. I think it was Thursday or something, maybe Friday. He had an announcement from Europe that they were going to continue to wean themselves off Russian oil. That pushed crude oil prices, I think, at one point up to 114. We closed at about 112.70. Energy sector was one of the few positive sectors that we got last week. It was up 1.25%. We also had defensive sectors, healthcare and utilities, eked out real small gains. And we had, surprisingly, iShares Biotech ETF, symbol on that is IBB. It wasn't up much, but it was up for a second straight week, which is something to at least look at. It was up 2.2%. I think the week before was up about 0.5%. So that might be something to take a look at. I also know that some of the big pharmaceuticals are still outperforming the market in here. people want to look at that as a defensive play. As far as on the downside, like I mentioned earlier, the consumer sectors, they were the weak spots. You had consumer staples was down 8.12%. Consumer discretionary was down 7.8%. They took the biggest hits, and then industrials and technology were also down sharply. I think they were both down more than 3%, or actually more than that, about 3.5%, 4%. And we had rising yields after Powell's comments. We had the 10-year went back above 3%. It did come back on Friday, where it closed at 2.79, and it's down again today, which I'll mention here in just a couple of minutes. What we're seeing with that, but basically what's going on is not too many people think that right now that the Fed's going to be able to maneuver a soft landing, while they're raising rates to fight off the inflation. They may get some breaks in the fact that like yesterday we saw a nice bounce in the financial stocks. That we had some nice comments from Jamie Dimon. He mentioned that J.P. Morgan Chase would have to up their earnings estimates because of because the rates are higher, they're getting more interest income. And we also found out Warren Buffett's Berkshire Hathaway had been buying Citigroup here over the last month or so. I mentioned yesterday that the regional banking ETF, KRE is the symbol, was up almost 2.5% yesterday. That's a good way to get a nice dividend and also not have such single exposure to some of the banks that I'm not wild about the banks. You're in an environment where when rates are going up, they should be outperforming, but we're not really seeing that. In fact, a lot of the banks are down 25% or so, and that's mainly because I think what you're seeing in the bond market, especially today, you're seeing economic data start to lessen. We had new home sales today were down 16.6% in April. That's showing slower growth. You're getting Europe was saying that yesterday they were going to start to bump up rates. They've got to get on this inflation deal. That's also going to slow growth over there. And a lot of analysts are just saying that we're gonna probably go, if we're not already in it, have a global recession, which is kind of unheard of. I think if that's the case, you still want to be in the United States, be in our market to own some stocks. But yesterday we came out here, we had a big jump. The Dow was up, closed up 618 points. I think it was up almost 700 points at one point. So it was up almost 2%. You had a nice bounce in tech. It gained 180 points. It was a little bit slower to react to points, but he had big moves in J.P. Morgan, Visa, American Express was up good, and then with the rates coming down, you actually had a little bit of a bounce of some of the big cap technology stocks. Apple, Microsoft, Alphabet, they all led the NASDAQ up a little bit higher. You had some strength in some of the gaming stocks, and I don't mean casino stocks, gaming stock. You had Electronic Arts, EA is the symbol. It was saying it was putting itself up for either a buyout or a merger. And then you had Take-Two Interactive Software, which is TTWO. It was up 6.5% after they closed their buyout of game maker Zynga. So a couple of things going on yesterday that gave stocks a nice little bounce. That went to the wayside, mid-morning this morning. That we saw when we opened up again. It was because of the worse than expected economic data. You had what was it? The S&P services sector showed a bigger than expected decline. Flash services index was below estimates. Manufacturing index fell to a 3-month low. Like I said, the new home sales were down 16.6%. That's the 4th straight month that we've had new home sales fall. As rising rates are starting to take a toll. Then last night, I think it was last night, it came out in Snap, symbol SNAP. They said that they were, going to be way down on their advertising dollars, and that just slammed Metaverse and Alphabet. FB for Metaverse and Alphabet GOOGL. They both hit new 52-week lows today. That pulled the NASDAQ down over 300 some points, almost about 3% at one point. We're starting to get a little bit of a bounce back. We'll have to see how this market closes today. Every sector was down earlier, but we did see some buying when we were way down in the consumer sector, consumer staples, and also we saw utilities post positive. That was good. XLC, which is communication services, it was down 4% at one point today. So that was a rough, kind of rough go for the guys who are trying to nibble away down here. That was kind of a surprise, I think, because you didn't see that in the when the earnings came out for some of these stocks. We're getting a little bit of a bounce back. It's going to be pretty important to see how we close today. Normally, historically, what you see is Memorial Day week. It's kind of Wall Street kind of closes down early. They start taking off for the beach and start their summer vacations. And you usually have low volume trading days. Yesterday, actually, with that 600-point move, I mentioned last night's comment that it was pretty low volume. It's probably the lowest volume day we've had in about a month or so. So that was, not confirming that you would have that big of a push. But again, when you get these big cap technology stocks leading the way, you can have oversized moves. So, but if we start to see, this thing start to break down into the close, that's not going to be good. Some of these guys may stick around. Some of them may not want to be holding securities over the long weekend in case anything really bad goes on. And what we're going to try to watch is some of these numbers that we talked about on a market letter last Friday. I mentioned that, a lot of times we've already seen the S&P 500 and NASDAQ retrace 38.2% of the total move from the low of March up to the November and January highs. And usually if you break through that 38.2%, there's a real good chance that you're probably going to retrace 50% of the move. So the Dow Jones has not hit that 38.2% yet. It came really close. So the target on the Dow Jones still remains about 29.4, 29.8, somewhere in that region. I think for the Dow Jones to qualify for a bear market, it would have to get down to around 29,440. So I would imagine we're going to see that probably here, if not this week, and depending on how we close. If we have a bad close, it could break 30,000 possibly tomorrow. As far as the S&P 500 goes, it's next down. We hit our downside target. We hit the 3,800 to 38, I think 3850 or something like that was our downside target that we printed a couple of weeks ago. We hit that intraday, and on a closing basis, the next downside target for the S&P 500, which would be the 50% retracement mark, that comes up around 3,500, 3,520. There is some support around 3,600. But so if it gets down to 3,600, you might consider maybe nibbling away at something. But probably you're going to see that 50% retracement, which would be the 3,500, 3,520. And for the NASDAQ, we're getting real close to that. That 50% retracement of that whole move would be 10,400. And I believe, let's see here, we hit, we almost got down to 11,000. So, we still have not had that washout bottom. It may feel like it when you look at your 401ks or your investment accounts. It's like we've had a washout, and and I know a bear market when they extend like this, you don't have the V recovery. They're painful to say the least. But we're still, the VIX is still staying today. We've got back up over 30, but it's kind of hanging in there around. Just under 30 most part of the time. We want to see some selling where we start to see that VIX crack up there, maybe 42, 43, 44. That would show that people are throwing the baby out with the bathwater, and we just have not had that yet. I think it got to 38 one time, maybe back in March or April, where we had something like that. We also we want to see in some of the secondary indexes, and by that, I call them secondary indexes. That's kind of my thing. Where you talk about the Dow Jones Transportation Index, the small cap Russell 2000, Philadelphia Semiconductor Index. You would like to see those lead the market higher and lower. Unfortunately, last week, transports and Philadelphia Semiconductor were both down more than the major averages, which was not a good thing. We did see that the small cap Russell 2000 did diverge a little bit. It didn't have too bad of a day, but or week. But we're still have we're oversold. You just don't. People that are jumping in trying to buy the dips are getting pretty much getting crushed when it happens. This isn't something you don't want to jump in here and buy these dips until you can actually see to see some kind of positive divergences going on in some of the different indexes, mostly the secondary indexes, and we're just not seeing that yet, or some of the underlying breadth indicators that we watch. So at this stage, normally it's kind of a boring week. I think I wrote last night that Stock Traders Almanac says that this is we usually have lackluster trading. The market usually ends up flat. But with equity so oversold, I thought maybe perhaps we might see some nibbling away going into the weekend on low volume. But we'll have to see. Right now I guess we're up a little bit for the week, but not by much.
All right. So not much to hang your hat on if you're a bull right now. Let's take a minute to go over some technical indicators that our subscribers can look at as a sign that might be early indications that they should begin trying to get back into the market.
Yeah, why don't we let's go to the home page, the market recap, Will. And what I want to look at, we have this on. You go to the home page, and on the right-hand side, just below some of those numbers we have there, what the percentage are up and what are down, that kind of thing. We had the market recap, and that's updated, and it follows a lot of the indicators for you that we track. If you go ahead and click on that. One of the most important ones, and I mentioned this last week on Thursday and Friday, and then on the weekly thing, we did start to see a little bit of positive divergence going down to the NYSE Advanced Decline line. There you go. And as you can see here, this has pretty much been a little steady, just a steady decline, stepping down. You did see back there in March when I think the market jumped on like 7 or 8% and from the lows up to the highs in about 2 weeks. Now, you always have these real strong counter rallies in a bear market, which kind of seem to what they do is they suck everybody in, and then the next thing you know, you're looking, you're down again, and the market's going even further down. Now you see here on the lower right-hand corner, you did see a little bit of positive divergence in the NYSE Advanced Decline line, where we actually had a couple of days on the NASDAQ also, where the market was a little bit down, and it was, and this is what you want to look for. You actually have more issues trading up than down, despite the market going down. That means there's some buying going on. It's not enough to move the market and start a counter rally or anything like that. But if you want to see this now, normally with advanced decline lines, and unfortunately this year it wasn't quite as noticeable. You'll start to see at a top, you'll actually see the advanced decline line actually start to roll over about a month or so. It used to be 3 months is what they used to teach us a long time ago, but now it seems to be about a month before you start to see the market really start to fall out of bed, it peaks before the actual market rolls over. That's something that you want to see. So you want to start seeing this sideways to up type of market when we're going here. I was just trying to look back to see when the advanced decline line peaked back in December, but I don't have my notes in front of me. But again, it was like about a month or so before the market actually rolled over in January, and that just is a very nice hint that where that negative divergence at the top, you're starting to see this thing start to move. We want to see that at the bottom also, where as the market's still going sideways, maybe down a little bit, the AD lines are starting to drift higher. And you also, another thing we want to watch just below that, move the charts down a little bit, Will. And you'll see right here on the NYSE and NASDAQ new high, new lows list. And you want to start to see this thing. We're still hitting. This isn't quite as effective as the AD line, obviously, because if you're near the bottom, you're going to have a ton of new lows. But you do want to start seeing these things maybe start to flatten out a little bit, where you don't have these big spikes going up. So that's something that we kind of will take a look at. Let's go now, Will, to the charts on MarketEdge. Let's put in this S&P 500. Okay, and I want you to nose down a little bit in here, and let's go and take this chart out about maybe to 20, not quite that. Go out to about maybe January 2021. That would be good enough. Now, some people want to know, can I look at charts and without me saying something or listen to some talking heads or something? You don't want to, once they're starting to talk about things, you kind of know it's already going on. So certain things that I look at and other technicians are going to look at that are fairly effective. First off, let's take a look up here at the 14-day RSI. There's a woman named Connie Brown. I think she's in Atlanta now, but she's very good at doing targets for institutional clients and all that. And normally, what you'll look at on the 14-day RSI is you're looking, okay, well, if it gets up above 70, it's overbought. It gets below 30, it's going to be oversold. And what you're looking for, you're trying to see this, the RSI, the indicator move up or move down as you start to see a trend. You can see the thing, the RSI starting to move up when the market's kind of going down. You can see maybe some positive divergence in that. But what Connie did, she did a long study, and she found out that when you're in a bull market, and if you'll look at this over here from, let's say, move this thing out of my way. Okay, let's go over here starting around January 2021. That's a good place to start. And if you look at this, the 14-day RSI, when we had these sell-offs back here in February, 1st of February, and then the 1st of March in 2021, if you go down to the bottom here, you look at this 14-day RSI, that thing never got below 40. Okay, and you even go all the way into July. You can see every one of these little pullbacks on this timeline here. If you go into the, what's this one here? I guess I'm covering this thing here a little bit. If you go back into June of 2021, you see that little dip down there. The 14-day RSI only got to about 48. And then even up here in September, where you had this pullback in here, and then you got let's see, September 21st, and you came in here the 1st of October. You also had a little bit of a pullback. But even on those, if you go down here to the thing, you finally at those sell-offs you got to below 40. Now, what Connie's noticed that when you're in a bull trend, you may dip down to a 38, which it did on that first dip on there in September 17th or whatever, September 20th. You did get down to about 38, but then you bounced back up. And the next one you actually broke and got down to like 34, 35, something like that. Okay, but then we started to have a bounce back. Well, the thing got back up to 70, well, almost to 80 up there when we got to, when we got up there on November 5th. Okay, that's right around where the NASDAQ actually started going. Then we kind of traded sideways. 14-day RSI went down in January or November to about 30, actually about 41. But then you notice that once we get down over here, the first one in January 21st, 14-day RSI actually got down here to into the 20s. And what Connie noticed is in the bull market, you're going to stay above 40 on these pullbacks. And on the bear market, when you start to drift into that, you're going to go below 40 on this 14-day RSI. And then when you have these rallies like you did in March, okay, well, that March rally, this thing got to 68. And what Connie notices is that you need to see that RSI get above 70 to all of a sudden say, okay, I think we may have had a short-term bottom there. That we may have some more follow-through in it. And even that big one in March, we didn't get that. It got almost to it. So that was a heck of a rally. And then we've rolled over. Now we're back here where we're down here to 29 and 30s on that as the market comes down again. We're down here in the 36.27 or 38.60s and stuff, and that, Friday's low was around 38.15 or whatever, and you're seeing that's down here now. Even yesterday's 600-point rally, you're seeing this thing not even get up to the 40. So that's something that we watch. It can be an early hint for you. And if you see this thing on a little counter rally, you start to see that 14-day RSI get above 70. That might be a sign for you that hey, this thing's probably has some sticking power. Now, another thing that some traders will watch, and this is a little bit lesser known. Let's go. You see that we had a little bit of a high. You had the high in March and on April. Looks like around April 21st or so. You had another counter bounce. Okay, and if you look at this, the ADX line, which is the orange one on this chart, then you look at DI plus and DI minus. Whenever you see, this would be for a trade. In this case, we had it didn't actually cross there, but it almost did because of that rally. The DI positive almost went above the DI negative. But when you see the ADX trade below both of the DI indicators, and then you see it tick up from below, that's an indication that you're starting to get another trend. In this case, okay, we saw the ADX line tick up right around April 22nd, April 23rd, and then you had the DI line moving up higher. That's another thing that traders will look for. They know we're going to start another pretty good, move, like a swing trade in the market. And of course you did. You started right there on April 22nd, and we, it's been a hell ride all the way back. If you go back to, ideally you're going to see that ADX line will be, below 20. Now, if you go back to, let's go back to June, let's say June 24th of 2021. You'll see a little bit of a pullback in there. A little dip right down there around June 18th. You have 2021. You have the market pull back, and then all of a sudden over here around, it's like June 25th, June 28th, somewhere in that area. The ADX line was down to 12, 13, 14. You started to see that start to move up, and then you started to see the positive DI line moving up. Okay, that was another sign you could probably get a swing trade out of this starting around June 29th. And of course, then that you rode that all the way up to about mid-July. Now, what these traders will do is they'll ride that trend as long as the ADX line is moving up. As soon as it moves, ticks down, as you would see here recently over to the right side of the chart, at that bottom on March 14th, 2022, at that bottom there, you'll see that the ADX line, the orange line there, all of a sudden goes sideways for one or two moves, and then it starts down. Okay, that meant that downward trend at that point was over. Okay, so these are some of the indicators you can look at on charts that are going to give you just a little bit of hint. Of course, in this case, with the RSI below 14, you're looking for maybe that counter rally to come down, and then have the ADX line come below the 2 again, and then you'll see if we get it. And you want to kind of go with the trend, in other words, with these things. So those are some of the things that you may want to look at. I did want to touch base on a few things real quick. We look at ratio charts, which we don't have on MarketEdge. But there's, what are the things you're looking at now with rates? The Federal Reserve saying we're raising rates, and yet you're seeing like today, the yield on the 30-year fell below 3%. You had the rate on the 10-year fall down to 2.75. It's actually going up a little bit here in the last couple of minutes. Got down to 2.73 or 2.72. That's just showing you that people are getting pretty scared, that they think that we've got another leg probably to go on the downside. But when you look at ratio charts, and what that does, if you can find them somewhere out there, that will tell you how what sectors or ETFs or something are actually still outperforming the S&P 500. Now, I looked at it yesterday, and some of the ones that are outperforming, IBB, again, I showed that's outperforming the S&P 500 a little bit. XLE, of course, with the energy is, and then XLU is another one. We've talked about this before. When rates are going up, why are people still buying utilities and consumer staples and REITs? And the reasons being is because they know the stocks are going to go down. We're going to stagflation. Interest is high, growth is slowing, and we still have to move rates up, and that's because they want to go. Some of these funds have to be invested in equities as a certain percentage, and so they're buying utilities and energy and things and consumer staples because they have to be in something, and those are defensive sectors. They're not worried about the higher rates. They're worried that if they go into something that's not defensive, that they're going to get crushed. And so this is just kind of the opposite of what you see. We talked about this several weeks ago, that it was kind of counterintuitive that, if the rates are going up, why don't I get rid of my utilities and buy something that's going to be more growth oriented? Well, no, you don't. If the growth oriented stocks are going to be going to get crushed like this, so that's another sign that things are bad. As far as today goes, I think that today and tomorrow we'll probably have some kind of bounce. I think at 12:30, and this is probably what's going on right now. We were down about 500 points earlier. I'm looking now. The Dow Jones is trying to go positive again. Got almost to the flat reading. You had Chairman Powell talking a little bit at 12:30 to 1:30. He may have said something that I think it might have been maybe saying something that if we see the growth starting to slow, that maybe that'll trim some of the inflation expectations. That's about the only thing I could think of with the economic news that was coming out. But maybe the Fed's going to get lucky, and we'll see slower growth start to help pull in the inflation and make it a little bit more transitory. But at this stage, we're not. This is normally, I say, a lackluster week. This isn't something. If we just go sideways, and we probably will snap our 9-week losing streak for the Dow. But I wouldn't be looking for something big. As far as our cycles go, we're looking probably for something a little bit of a counter bounce maybe here in the next week or two, but then looks like they go back to another sell and probably bottoming sometime in August or whatever. And I mentioned a week or two ago that as far as this year, when you have the midterm elections coming up, generally the market doesn't do much of that because they want to see, what's going to happen. And this year it looks like we may have a changeover with the House or the Senate, with the Republicans taking at least one more branch back, and that could put a real damper on anything of Biden's spending plan. So, then historically after that, after you start to see who's going to win, what the results are going to be, then you usually will have a rally into the end of the year. So, unless you're just doing some swing trades for off of some kind of news, there's really at this stage I would keep cash in my account. When you have some crazy sell-off that you just don't understand it, you give it a day or two because you might see something come out like where Google was moving back to where they were moving back toward that 2350, 2400 area. And then Snap comes out and they say their advertising is going to be, way down. Then you get these big sell-offs where Facebook's down like 8% today and Google's down like 5-6%. So again, just be very cautious. This is not a buy the dips. I don't even know if it's a sell the rips. I don't think there's enough people out there swing trading this to move it that much. But just be cautious. Again, right now I think cash is where you want to be. And that's about what we have until next week.
All right. Well, that's all we have for you today. Remember, if you have a question you'd like to answer in the next Tuesday Tech Talk, you can email it in support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.